It happened in a single afternoon, February 4th, 2026, a Tuesday that started out completely normal and ended with $285 billion of market value just gone, vaporized. You probably saw the headlines. The Nasdaq took a hit, sure, but if you look closer at the wreckage, you'll see something way more localized, something scarier. We aren't talking about a general market crash. We're talking about a targeted execution of the one thing every investor thought was safe, the moat. That big, beautiful wall around a business that keeps competitors out and the cash flowing in. For decades, companies like S&P Global and Moody's were the forever stocks. They owned the data. They owned the workflow. You couldn't run a financial system without them. Until yesterday. And because we track this stuff every single day here at WealthWire, we noticed the trigger. It wasn't an interest rate hike. It wasn't a war. It was a software update. Anthropic released a new set of agentic tools for Claude, and in a few hours, the market realized that the moat isn't just leaking, it's gone. So why does this matter to you? Because if you're holding what they call information services or legacy SaaS, you're standing on a trapdoor. The smart money, it's already halfway out the exit. We need to talk about why 5 specific stocks just got their death warrants signed, and more importantly, where that capital is actually hiding now. Reality number 1. The per-seat lie is dead. For 20 years, the greatest business model on earth was selling software licenses per person. You have 100 employees, you buy 100 seats. It was predictable, it was recurring, it was a money printer. But look at what happened to Salesforce and Intuit this week. When Anthropic showed that an AI agent can handle 80% of a compliance or legal workflow, the math changed instantly. Why would a firm pay for 50 seats of a legacy platform when one AI agent can do the work and just needs a single API connection? The market finally woke up to the fact that headcount-heavy software is a liability, not an asset. It's like when the car first showed up. People didn't just buy fewer horses, they stopped needing the entire infrastructure of the stable. These companies are the stables, and the horses are being replaced by code that doesn't need a desk, a pension, or a login. Now look, I'm just reading the data as it hits the terminal. I'm not your financial advisor. Always do your own research before you go moving your life savings around. But the numbers don't lie. When S&P Global drops 11% in a session because an AI can suddenly parse proprietary data better than their own analysts, you have to pay attention. Reality number 2, the proprietary data myth. This is the big one. We were told that companies like Moody's and Thomson Reuters were safe because they sat on mountains of data no one else had. That was their wall. But here's the secret. AI doesn't need to own the data to extract the value from it anymore. These new models are so good at reasoning through public filings, legal precedents, and market signals that the exclusive edge these giants had is thinning out. The market saw Thomson Reuters slide nearly 16%. Why? Because the co-counsel world they built on OpenAI just got a massive competitor from the very people who provide the brains. When the model provider becomes the workflow provider, the middleman gets squeezed until they pop. It is brutal, really brutal, and the retail crowd is usually the last to find out. While the headlines are talking about a tech correction, the institutional desks are identifying the AI losers and dumping them with a get-me-out mentality. Secret number 3. The smart money isn't just sitting in cash. They're moving into point-of-origin assets. If the software layer is being eaten, where does the value go? It goes to the 2 things AI can't fake: physical power and sovereign hardware. While the software giants were bleeding out, look at what happened to the energy sector and the custom silicon plays. The money is flowing into the companies that own the electricity and the specialized data centers. It's moving from the what to the how. Think about it. If AI is going to do all the legal work, all the accounting, and all the coding, the demand for the output of those jobs stays the same, but the cost to produce it drops to near zero. The only thing that stays expensive is the compute required to run the agent. The smart money is buying the gas stations of the AI era, not the cars.
The climax of this whole mess is the realization that safe has been redefined. We used to think safe meant a company that had been around for 100 years. Now, 100 years of legacy is just 100 years of technical debt that an AI native startup doesn't have to carry. Look at Gartner. They've been the kings of insights forever. They dropped 20%. 20% in a single day. Why? Because why would a CEO wait 3 months for a Gartner report when they can have an AI agent analyze their entire industry in 3 minutes for the cost of a cup of coffee? The moat didn't just fall, it was bypassed. The world is different now. The stocks you were told to buy for your retirement, the ones with the wide moats and the unshakable dominance, they just became the most dangerous things in your portfolio. The rotation isn't coming, it's here, and it's not going to be kind to those who are still waiting for things to go back to normal. Normal is dead. The agents are here, and they're hungry. Would you like me to analyze the specific point of origin stocks the smart money is moving into so you can see the other side of this rotation?